Good morning, everyone.
Good morning, sir.
Can you hear me? Good morning.
Yes,
Can
sir.
you see my slide? Are you able to see my
Yes, sir.
slide? Okay.
Okay, sir.
Uh, shall, uh, yeah, yeah, here. Yeah, right. Hmm. Uh, yesterday, yesterday we discussed up to we have discussed about basis of financial accounting and what are the objectives, scope, and functions of financial accounting. See, today we are going to discuss the major thing of financial accounting, that is about the outcomes of financial accounting. What are the outcomes of financial accounting? So, after completing the whole recording process and after the preparation of trial balance, the major task of financial accounting is to prepare the financial reports or the financial statements. So, for the purpose of analyzing the company performance and the company financial position, all the business transactions are broadly classified into five categories. They are revenues and incomes, expenses, profits and losses, gains and losses, assets and liabilities. So, all the business transactions can be roughly classified into these five categories broadly to understand the financial performance and the financial position of the company. So, let us try to understand each component in detail. Revenues. What are revenues and what are incomes? See, why we are doing the business? We are doing the business as as a part of social requirement. That is one point of view. And the other thing is that we have to generate the revenues. Revenues are the major source of income for the business. Without revenues, there is no business going to be run. These revenues can be of different types. It depending upon the nature of business that we are doing, depending upon the form of business we are doing, the revenues will be of different types. For example, for a manufacturing unit, revenues can be generated from the manufacture and the sale of goods. Manufacture and sale of goods. Typically, a manufacturing unit manufactures its own goods on its own, and they will try to sell the same goods for the purpose of generating the revenues. Those goods are the major source of revenue generators for a manufacturing concern. So, for example, an automobile company. Automobile company manufactures automobiles or automobile parts, and then they will start selling out those goods. So, by selling, they will generate the money, and that is revenue for a automobile company. In this will be the type of goods will be vary for different type of manufacturing unit, and they are considered as the sources of revenue generations. And for a trading company, the revenues are generated from the purchase and sale of different types of finishing goods. Typically, a trading company will not manufacture any goods on its own. Basically, they are mostly the retail
Voice is not coming, sir.
Now it is okay? Audible now?
Yes, sir. Yes, sir.
So other sources of revenues includes interest, dividends. These interest and dividends are generated by making investments in outside companies. In addition to that, they can get fees by providing any other services, uh, which are services, and subscriptions also they can generate for a subscription-based services. They can get subsidies from government for a manufacturing concern for the purpose of tax saving schemes. So in this way, they will get additional revenues also. So this is broadly about that what are revenues for a company. Depending upon the nature and type of a business unit, the revenues can be of different types. And when it comes to specifically to the classification of revenues, we can broadly classify the revenues again. If they are subdivided, they can be again of two types. So far, what all the revenues we have discussed up to now are called as revenue receipts. Why we call them as revenue receipts are because they are recurring in nature. They are not one time in nature. So the objective of doing a business is to get the recurring revenues regularly, so that a business can be successful. So such type of revenues are called as recurring revenues. On the other hand, we can also get revenues from non-recurring in nature. That is, we can also get revenues in the form of ad hoc nature also. Say, for example, we have assets. We have sale of the fixed asset. So we may get an income out of that fixed asset. So this is not a regular income that a company will get. So this is an ad hoc based loan. It is a time based loan. So there are such of transfers that will happen that will generate infrequent revenues for a company. Those type of revenues are called as capital receipts or capital receipts. This is briefly about different types of revenues that a company will generate in its normal course of businesses. Now, next, and the next component is expenses. These revenues cannot be generated automatically without making efforts. So there should be a push for the generation of these revenues. How this push can be given? This push can be given in the form of human support. We have to receive human support in different forms. So, and also we need some infrastructure to run this to create a utility for the business. So for that, we have to make an expenditure. We have to make expenses. Expenses are nothing but making investments. They can be, that is, outflow of cash. Expenses are the outflow of cash that are intended for the purpose of revenue generation. See, without incurring expenses or any expenditure, revenues cannot be generated. So, depending upon the benefits associated with an expense, what kind of benefits we are going to get by making an expense. Expense is nothing but making a payment in the form of cash. So when we are paying a cash, so what kind of benefit we are going to get? So the benefit for paying a cash is basically different in the form of its time frame. When we made a payment, or when we made when we incurred an expenditure, if that benefit is for a short period, say for example it is for less than 1 year, if that benefit continues for less than 1 year, then it is called as a revenue expense. If we are making an expenditure or expense which has a more than 1 year, say for example 5 years, or see, it can be beyond 1 year. So that type of expenditure is basically called as a capital expenditure. Capital expenditure. Let us consider some example revenue. Revenue expenditures are basically incurred to the operator. They will continuously every month, and there will be salaries, wages, payment, utility bills, advertising expenses, because they are mainly responsible for the generation of revenues for a company. Without payment of salaries or wages, sometimes we cannot get the revenues generated for a company. Similarly, as I already told that If the benefit of an expenditure expense beyond over a period of 1 year, then such type of expenditure is called as capital expenditure. Say they are want to create build to create furnitures, we want to create uh, plant and machinery for running our business. So when we are making an expenditure while investing in these type of activities, such type of investment expenditures can be called as capital expenditure. For example, purchase of land, purchase of building, purchase of plant and machinery. So these are all called as capital expenditure. So this is basically about expenses. So for the purpose of generating revenues, a company has to incur expenditures that are both recurring in nature and non-recurring in nature. And then there comes the major part of preparing a financial statement. Profits are the actual outcome of business operations that are available for the actual shareholders of the company. Why we are doing the business? The purpose of doing the business is to get the profit. That is, we should get the benefit. We are making an investment. Out of that investment, we should receive a benefit. That benefit can be in the form of profit. This is what return that we will get by doing a business. Apart from providing services to the society and to the customers, the shareholders also has to get the benefit. That benefit can be seen in the form of profits. Then what are profits? Profits. Profits are calculated by following the matching principle. We have read about the concept matching concept in the earlier classes. The matching concept basically states that we have to compare the revenues and revenue expenses and revenue receipts that we have received during a year. Just now we have learned about what are revenue receipts and what are revenue expenses. These are nothing but the revenues that we receive during a year, one particular year, and the income expenses that we have incurred during a particular year. So, if the revenue receipts exceeds the revenue expenses, then a company is said to be considered to have a profit. If if the revenues are more and expenses are low, it is obviously we can say that the company is earning profits. And at the same time, if the revenue receipts are less than the expenses, more expensive. In this case, loss, that is, it is not making any effort benefit the shareholders of the company. So the important, we already discussed the question of accounting policy. Whenever we are formulating an accounting policies, we should make a very knowledgeable decision with respect to the recognition of revenues and with respect to recognition of expenses. Why? Because any decision which may reduce the revenues or any decision which may increase the expenses may have an effect on the profits of the company that is going to be generated during a year or over a period of time. So care must be taken in terms of defining a policy for the revenue receipts and revenue expenses of a company. And then this is about the profits and losses. And next, let us go to what are gains and losses. What is meant by a gain? What is meant by a loss in this respect? See, already we have discussed about profit. Profit is nothing but that what we have got from the revenue expenses and the revenue receipts. But gains are that what we are gained from the capital receipts. As I already mentioned that we will make a capital expenditure, that is investments in infrastructure, which will have a longer period of time. See, after some time, there are chances we may sell a fixed asset, we may sell a plant and machinery or land or building. So when we are selling a land or any plant and machinery, if you get a benefit out of that, so then that means if you are getting more than the book value of that plant and machinery or land and building, so then we can say that we are generating a gain. A gain means that we have that the additional amount that we are generating on the sale of a fixed assets or a capital asset. Like similarly, we are having a liability. So when we settle a liability, which is we settle a liability which is less than the book, which is less than its book value, then we are going to gain out of that. So this is also called as a gain. Similarly, when we sell an asset which is having a book value which is less than its book value, then we are going to incur losses also in this case. And also, if we settle a liability more than its book value, for example, if you are going to pay any penalties or any fees, any legal charges if they are incurred on the settlement of liability, then it is beyond the book value of such liability. Therefore, in this case also, we will generate the loss. So, this is the basic difference between a gain and a profit. Profits are incurred in the profits are those which are incurred in the regular business operations. Gains are those which are incurred in the form of capital receipts. Capital receipts. Okay. So this is about gains and losses. Next. And so far we have discussed about understanding the how to understand the performance of a company by calculating revenues, calculating expenses, and by calculating gains, losses, profits. So with this, we will understand based on the profitability of a company, we can make a guess or we can make an assumption that whether the company is doing well or not. But the ultimate thing lies with the it gives a figure of assets and liabilities owned by a company. Basically, basically one thing we have to understand is that a company does not own anything on its own. Though it's a legal entity, it is run by the people only. So whatever the company is receiving, anything it doesn't own on its own. It doesn't have anything on its own. Even the share capital that it is receiving also, it owes to the shareholders. So at any point of time, whatever the money the company is receiving, it has to settle that money at any point of time. Okay. So it has to settle the money. So, what all the sources of money from where the company is getting, whatever the sources of money company is getting from different sources, those are all liabilities to a company. And using that sources of money, so which are called as liabilities, the company can create various assets. Assets are applications of money. So this can be shown in the balance sheet. All the sources of income and all the applications of income can be shown in the balance sheet. A company receives money in different forms from different sources. So shareholders are the major investors keeping money into the company. They are the actual owners of the company, and all the other remaining are called as outsiders. The company gets amount from different sources, different outside sources.
Sir,
Hello.
sir, Nagender sir.
Yes, ma'am. Yes, please.
Sir, please show screen also, sir.
You cannot see the screen.
PPT, sir.
You're not seeing.
Not seeing, sir. Only seeing your video, sir. Not PPT.
Now.
No, sir. Yes.
So
It's
some
okay.
technical problem.
Okay.
Okay. Some
Okay.
technical problem is happening. Please inform when you are not able to see it. Okay. It is
Okay, sir.
disconnecting.
Thank you, sir.
Okay. Yes. A company. Okay. Once a company receives cash from different sources, it owns the cash and holds it as a asset. See, as I told that we will receive cash from different sources, so mainly from shareholders and other outsiders also. Once we have received that cash, a liability is created, and accordingly, the company receives the cash, and that cash will be shown as an asset in the balance sheet. So, in this case, the liabilities and assets will be matched. Accordingly, uh, based on the cash received, the company will create different type of infrastructure, and for that, there will be an equivalent liability that a company has to settle during its lifetime of its running. So this is about what is meant by asset and what is meant by liability, and why a balance sheet will get tallied at any particular point of time, because all the liabilities or all the obligations that the company is having, it has to be settled at any particular point of time through the creation of different assets and through the creation of different assets. And when it comes to types of liabilities and types of assets, so the settlement of liabilities is dependent on the time period. Some liabilities are very short term in nature. So short term in the nature, and some liabilities are long term in the nature. What are short-term and what are long-term liability? See, when a liability, when you received an amount, when you have an obligation which is to be settled in a short period of time. Say, for example, if you have to, say, for example, if you have to settle a liability, say, for example, creditors. Creditors are those who we will own for the purchasing of for the supplying of the goods. And in addition to that, we will also get some short-term debts for managing the working capital requirements of the company for the management of its day-to-day operations. So these obligations are basically short-term in nature. So we have to settle them within a period of 1 year, and the time period depends upon the nature and functioning of the company. Mostly, the short-term liabilities time period will be less than a year, and long-term liabilities, as we already discussed that, long-term liabilities are basically of two types. One is equity, and another one is debt. Equity share capital and equities are also different forms. Equity share capital is contributed by the actual owners of the company. The owners of the company will not have any right, they will not have any right to claim any regular payments. They will only have an obligation at the discretion of the management, they can get the return. But as far as the debt is concerned, we have a specific obligation for the repayment of the amount. We have to pay the interest regularly. We have, and for a long period of time we have to settle the principal amount. So whenever the settlement period of a liability is more than 1 year, then that liability can be considered as a long term liability. So that means we can settle it for a longer period of time. and and also the classification of assets. In any business, assets, there are different type of business. Again, by using the cash we are creating different types of assets. So assets are also of different types. They are current assets and they are long term assets. Why we call them as assets? So when we are using a money and when we are purchasing any asset, or and when we are creating any sources of income, when we are creating any sources of income, so that will have the capability of again converting into the cash. So at at current position, though they may be having a physical form, so they have the ability to convert into a cash in the future. Likewise, if any if any value is created, like for example, if you are purchasing goods, so the goods in the form of cash will stay in the balance sheet. So it has the ability to convert into a cash within a period of 1 year. So in this way, we will have a plant and machinery. By using the cash, we have created a plant and machinery. This plant and machinery at any point of time can be converted into a cash, but the time period can be more than 1 year. So like that, by using the cash, we will have different type of assets, and which can be converted into a cash with a short period of 1 year, or which can be converted into a cash over a period of long time, say for more than 1 year. So like that, the assets can be which can be converted into cash during a period of 1 year can be classified as current assets, and the assets which have a longer period of time and which can be converted into a cash, or which will have benefits in the form of generating the revenues, can be classified as long term assets. There may be some financial investments also there, which has the ability to generate the cash in the long run. All this, the settlement period will be beyond 1 year for a long term asset. This is about assets and liabilities. This is about assets and liabilities of a company. And so far we have discussed the major components of preparing the financial statements. Those are revenues, expenses, and out of revenues and expenses, we can evaluate the profits and losses of a company, and also based on the capital expenditures and capital receipts, we can evaluate the gains we have generated from the business operations. And then the major thing, balance sheet, assets and liabilities. We can understand the financial position of the companies by how the company is utilizing its liabilities, that is the sources of revenues, for the generation of assets, for the creation of assets that are helpful for the that are helpful for the creation of infrastructure for the generation of revenues. This is basically about all the basic components of a financial statement. Depreciation. See, one of the important area in the one of the important point in the area of accounting is the depreciation. Why depreciation occupies a very important place in the area of accounting? Why? Because here we have to consider the major accounting policies like going concern concept and matching concept and materiality concept. So we will make investments in long-term assets. We already discussed that for the infrastructure is created in the form of long-term assets. See, long-term investments are mainly huge in amounts. See, for example, you received a share capital from a share capital of, for example, we have received a share capital of 1 lakh from the shareholders. So out of this 1 lakh, we have to create a capital asset. So, for example, we have to purchase a plant and machinery. The cost of that plant and machinery may be 50,000. See, out of 1 lakh we have received, we have invested that 50% in the creation of plant and machinery. But this is an outflow of cash. So, does it mean that we have lost the cash? No, we are not losing the cash. So, this is what we have learned in the going concern concept. So, the benefit of making an investment in the plant and machinery will last long for it will have a long lasting benefit. So, instead of showing it as an expenses, we will show it as an asset, because the benefit of which will be carried for a long time. So, by following the going concern concept, we have considered the value of that asset as a value of that expenditure as an asset in the balance sheet. So, then what is the important thing? Will that value be same for a long time? No, it won't be same for a long time. It will have a diminishing value, and it will have a diminishing value. So we have to make an adjustment for the diminishing value of the company. So how we have to make that diminishing? How we can make the value? How we can consider the diminishing value of that company and diminishing value of that asset? Sorry, diminishing value of that asset. So this is where the concept of depreciation comes into the picture. So depreciation, the value of the value of asset, how much of the value of asset we are utilizing for the generation of revenue is considered every year. So for that purpose, we will calculate the depreciation value, and we will decrease the depreciation value every year against the revenues generated during that particular year. So that what will happen is that the value of asset will be spread. How much value we are utilizing the asset will be reduced in the form of depreciation, and it will be spread across the years until the value of that asset is useful for the company. This is basically about the purpose of doing a depreciation. Let us understand the concept of depreciation. See, as I already said, it is the decrease in the value of an asset that is intended to be developed or purchased for the long-term benefit of an organization to run the business. So, that long-term asset can be developed by the company, or it can be purchased from the outsiders for the long-term benefit of an organization to run the business. If the benefit of the expenditure is more than 1 year and spread across several years, it is categorized as a capital expenditure, and it is shown as an asset in the balance sheet. The value of such asset is decreased over a period of several years in the process of business operations. Following the principles of going concern concept and the matching concept. A capital expenditure is shown as an asset following the going concern principle, and its value is reduced or diminished following the matching principle. This is what we have discussed, and matching principles. So, besides following the accounting criteria of going concern concept and matching concept, The process of depreciation also considers the actual life of an asset in determining the depreciable amount of that asset. The depreciable amount should be calculated on yearly basis so that it can be matched against the revenues incurred during the year. Okay. The amount can be used to create the provision for the purchase of asset at the end of life of an asset, or it can be settled against the asset every year and stores as a secret reserve in the form of cash. See, now we have to understand the important point. That is, we have created an asset. This asset has certain value and it is useful for a long time. So we cannot completely consider that its value is exhausted. So to consider how much of value we are considering it every year, we are following the depreciation principle. So to consider how much benefit we are getting out of this asset, and to benefit out of this asset, we are depreciating this value of this asset in the form of depreciation from the profits that we are earning every year. So whatever the amount we are depreciating, that is bringing down your profits. So whatever that is bringing down your profits every year. For example, you are earning a profit of, for example, in 1 year you earned a profit of 1 lakh. In 1 lakh you reduced this depreciation amount. So automatically the profits will come down, and that amount what you have reduced can be used as a form of provision for the purchase of asset after its diminishing value is reduced. And if you are not using it as, if you are not creating any provision, if you are not creating any provision, and if you are simply reducing it in the form of from the profit, then that amount which you are reducing without creating a provision can be uh, can be in the form of a secret reserve, stays in the form of a cash. So this is the basic theoretical background for the calculation of depreciation and for the accounting of depreciation. The criteria considered for the calculation of depreciation of an asset are: we have to estimate, we should have the actual cost of the asset, we should have the estimated life of the asset, and the estimated scrap value at the end of the asset. See what amount we have to deduct every year for an asset. How we have to deduct? We should deduct certain amount. How much amount we have to deduct? That can be calculated by taking the cost of the asset and estimated life of the asset, and the estimated scrap value of the asset, estimated scrap value of the asset. Let us estimated scrap value of asset. So these are the three basic criteria that we will consider for the calculation of depreciation of an asset. So there are different methods for the calculation of
Sir,
different methods.
sir,
Yes, please.
sir, not showing slides, sir. Only 8th point, now 12th point.
1 minute. Can you see now?
Yes, sir. But 9th, 10th, 11th, we are not seen, sir. On first to 7th also, we not seen, sir.
Slides, huh?
Slides, sir.
Now you are seeing?
Yes, sir.
Okay. You want me to repeat once again, briefly?
Yes, sir.
See, revenues are, revenues, the purpose of doing a business is to generate the revenues, and revenues are generated in the form of goods and services that a company is providing. For some companies, goods are the major source of revenue generator. For some companies, services are the major source of revenue generators. And for some company, in addition to sale of goods and services, the companies also generate revenues in the form of interest, dividends, fees, subscriptions, and from the government revenues also. So these are called as revenue receipts. So we will get revenue receipts are recurring in nature, and they will be getting regularly in the business organization. And capital receipts are those which we will get on ad hoc basis by the uh, sale of capital assets. So they are not recurring in nature. So revenues which a company is getting every regularly are called as revenue receipts, and they are regular in nature, recurring in nature. So for the generation of revenues, we need to incur expenditures, and without expenditures, the revenues cannot be generated. Revenue expenses are the outflow of cash that will help to generate the revenues. They are basically in the form of salaries, wages, and utility bills. So this will basically recurring in nature, and the revenues are generated on recurring basis. And in addition to this, some expenditures can also be incurred on the creation of infrastructure, which will be helpful for the generation of uh, uh, revenues in the long run. So such type of expenditures are called as capital expenditures. So they are in the form of land, buildings, plant and machinery, etc. So they are called as capital expenditure, which will have a benefit for a period of 1 year. And expenses which are having period of whose benefits is less than 1 year, it is are called as uh, revenue expenses. So profits and losses are the major source of major objective of a business. Based on the uh, by comparing the revenues and expenditures, we have to assess the profits of a company. Profits are the actual outcome of business operations that are available for the actual shareholders of the company. The profits are calculated following the matching concept principle of accounting by comparing revenue expenses and revenue receipts incurred or received during a year. If the revenue receipts exceeds the revenue expenses, then a company is considered to be earned a profit from its operation. If the revenue expenses exceeds the revenue receipt, then a company is considered to be earned a loss from its operations. The formulation of an appropriate accounting policy is essential in terms of revenue recognition and classification of revenue expenses and receipts, as it may affect the actual profits. Because we have to formulate an accurate policy in the determination of revenue expenses and revenue receipts, so that it will help to understand the generation of actual profits. Gains will be generated after the sale of any capital assets or after the settlement of any liability in the which is having a long-term value. So it is not a recurring revenue; it is a ad hoc revenue. It will only happen in a specific point of time. So those additional revenue that is generated after the sale of any asset or after the settlement of any liability beyond or below the book value, then it can be considered as a gain, or else it is considered as a loss. Assets and liabilities. We already discussed that assets and liabilities. Liabilities are the sources of money, and assets are the applications of the money. All the whatever the liabilities that are generating in a company are settled against the application of in the form of creating the assets. A company receives money in different forms from different sources. The sources of money or capital for a company are the shareholders. They are the actual owners of the company, and the remaining all are outside shareholders. Once a company receives cash from different sources, it owns the cash and holds it as an asset. Using the cash, a company creates different types of assets and create different type of assets. That means it creates infrastructures. Depending on the time period of settlement of a liability, the liabilities are classified as short-term liabilities and long-term liabilities. The liabilities which are settled within a period of 1 year are called as short-term liabilities. The liabilities which are settled after a period of more than 1 year are called as long-term liabilities, which are, for example, equity and debt. If the benefit of holding an item in the form of an asset is derived within a period of 1 year, then they are called as short-term assets. If the benefits of holding an assets, if the benefit of holding an item in the form of an asset is expected to derive called as long-term assets, that is plant property and equity. Depreciation. Depreciation is the decrease in the value of an asset that is intended to be developed or purchased for the long-term benefit of an organization to run the business. If the benefit of expenditure is more than 1 year and spread across several years, is categorized as capital expenditure and is shown as an asset in the balance sheet. The value of an asset which was categorized as capital expenditure can be decreased over a period of several years in the process of business operation, based considering the principles of going concern concept and the matching concept. A capital expenditure is shown as an asset. A capital expenditure is shown as an asset following the following the going concern principle, and its value is diminished or reduced following the concept of matching principle. So, besides following the accounting criteria of going concern concept and matching concept, the process of depreciation also considers the actual life of an asset in determining the depreciable amount of the asset. Depreciable amount of the asset. The depreciable amount of asset can be calculated on yearly basis because of the concept of matching concept. The depreciable amount can be calculated on the yearly basis, so that it can be matched against the revenue incurred during an year. The depreciated amount can be used to create provision for the purchase of asset at the end of the life of an asset, or it can be settled against every year, and it serves as a secret reserve in the form of. So normally, whatever that we are depreciating, we will reduce it from the current profits, and we will create a provision to utilize the provision for the purchase of that asset in the long run. But if you are not creating a provision for that, that amount will be in the form of a secret reserve that is available in the form of cash. The criteria that is considered for the depreciation of asset or the cost of an asset, estimated life of the asset, and the estimated scrap value or the end value of the asset. So when we have to calculate the depreciation amount of an asset, we have to consider the cost of that asset, we have to consider the estimated life of that asset, we have to consider the scrap value. Scrap value means we will have one book value for that asset in the book, but at the end of the year, it may, after selling that asset, we will get some additional amount out of that asset. Methods of calculating depreciation. There are different methods for calculating the depreciation. So out of that, all types of methods, important and frequently used methods of depreciation are straight line method and balance sheet diminishing balance method. So these both methods are simple and easy to calculate the depreciation. Here, the components that what we have discussed earlier, that is cost of the asset, useful life of the asset, and residual value, are similar for the similar for both the methods for calculating the depreciable amount. The choice of the method, which method we have to follow, depends upon the discretion of the manager. Criteria that can be followed, but for the purpose of taxation, when we are calculating the taxation requirements, when we are preparing the balance sheet for the taxation purpose, we can consider the diminishing. Yes, please.
Hello, sir. Sir, can you change the screen?
You cannot see the screen. Which
yes,
screen
sir, but point is off.
Now you can see.
Yes, sir. Next one.
Sir, point is different, but screen is different, sir.
Which point you are hearing now?
Second point, unit 4 unit
Second.
I am seeing, sir, but you are different points, sir.
Now you are seeing methods of calculating depreciation.
No, sir.
Yes,
Only
sir.
for second point is showing.
Slides are not moving, right?
Slides are not moving, sir.
One more. Now you can see the
Not showing,
methods
sir.
of not showing. You cannot see methods of calculating depreciation.
No, sir. Now
What?
Now showing, sir.
You cannot see slide now. Can you see now?
No, sir. Yes.
Yes, sir.
Now showing,
Now,
but you are telling different, but slide not going afterwards, sir.
okay. You
Now showing methods of calculating depreciation.
check now. The slide slides are
Sir, voice.
Not clear.
still still methods of calculating depreciation. In now the slides are అవుతున్నాయా
No, sir.
స్లైడ్స్ మూవ్ అవుతున్నాయి. హలో
సార్ స్లైడ్స్ మూవ్ అవ్వట్లేదు సార్, మీ వీడియో
హలో
కనిపిస్తుంది సార్.
లేదండి స్లైడ్స్ కనిపించట్లేదా? ఇప్పుడు వస్తుందండి? నౌ కెన్
నాట్
ఇప్పుడు కూడా
షోయింగ్ సార్,
కనిపించట్లేదా?
ఇప్పుడు కూడా రావట్లేదు సార్.
టెక్నికల్ ఇష్యూ ఉంటుంది ఇక్కడ. వస్తుందండి?
ఇప్పుడు రావట్లేదు సార్. నెట్వర్క్ ఇష్యూ అనుకుంటా సార్, రావట్లేదు.
అవునండి, నెట్వర్క్ కొద్దిగా స్లోగా ఉంది, బ్యాండ్ విడ్త్ తక్కువ ఉంది, అందువల్ల షేర్ అవుతుంది. ప్రాబ్లం నెట్వర్క్తో ప్రాబ్లం. కెన్ వి కంటిన్యూ? ఓవరాల్గా చెప్పమంటారా?
మేము నోట్స్ తీసుకుంటున్నాం సార్, అందుకనే మాకు ఫస్ట్ స్లైడ్ నుంచి అసలు ఏం కనిపించలేదు సార్. 12th పాయింట్ చెప్తున్నారు, మీరు 12 స్లైడ్స్ చెప్తున్నారు కానీ మాకు ఫస్ట్ నుంచి నోట్స్ లేదు.
అంటే ఇక్కడ స్లైడ్ షేరింగ్ అని వస్తుంది నాకేమో,
మేము స్లైడ్
అందుకని
కి
నేను కంటిన్యూ
ఫొటోస్
అవుతాను.
తీసుకుంటున్నాం, అందుకనే కొంచెం మాకు ప్రాబ్లం అవుతుంది సార్. తర్వాత
ఒక్క
నోట్స్
నిమిషం ఉండండి, మళ్ళీ
రాసుకోవడానికి స్లైడ్ ఫోటో తీసుకుంటున్నాం.
ఒక్క నిమిషం ఉంటే నేను మళ్ళీ మీకు షేర్ చేస్తాను, ఒకసారి చూడండి, ఓకేనా?
ఎందుకంటే
మళ్ళీ
ఇది
ఒకసారి
వీడియో
అన్ని షేర్.
రికార్డింగ్ లో కూడా ఉంది కదా, ఒక్కొక్కసారి యూట్యూబ్ లో చూసుకునే వాళ్ళు చూసుకుంటారు కదా, వాళ్ళకు కూడా ప్రాబ్లం అవుతుంది కదా సార్.
ఓకే ఒక్క నిమిషం, అంటే నేను యాక్చువల్గా షేర్ అవుతుంది, నాకేమో షేరింగ్ అని వస్తుంది, అందుకనేసి ఒకసారి చూస్తాను.
అదే మేము ఇందాక యూట్యూబ్ లో కూడా చూసాము, కాకపోతే మధ్యలో స్ట్రక్ అయిపోయిన వీడియోనే కనిపిస్తుంది.
అది ఇక్కడ కొద్దిగా టెక్నికల్ ప్రాబ్లం ఉన్నట్టుంది, నెట్వర్క్ స్లోగా ఉంది, అందుకని ఓపెన్ అవుతుంది.
ఓకే సార్, మీరు నెట్వర్క్
ఇప్పుడు
ఒకసారి
చూడండి అమ్మా,
మంచిగా వచ్చిన తర్వాత ఫస్ట్ నుంచి స్లైడ్స్ చూపించండి సార్ మాకు.
ఇప్పుడు వస్తుందా? చూడండి ఒకసారి.
ఇప్పుడు రావట్లేదు సార్, మీ వీడియో స్ట్రక్ అయిపోయింది.
ఒక్క నిమిషం నేను మళ్ళీ మీకు కనెక్ట్ అవుతాను, ఓకేనా? ఒక్క నిమిషం.
ఓకే సార్.
హలో ఇప్పుడు కరెక్ట్. హలో హలో స్లైడ్ కనపడుతుందండి ఇప్పుడు?
కనిపిస్తుంది సార్.
ఇప్పుడు కనిపిస్తుందండి స్లైడ్?
ఓకే సార్, కనిపిస్తుంది సార్.
ఒకసారి స్కిప్ స్లైడ్స్ అన్ని.
ఓకే సార్.
కనిపిస్తుందండి స్లైడ్స్? హలో 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 వాయిస్ వినిపించట్లేదు. హలో హలో వినిపిస్తుందండి?
వినిపిస్తుంది సార్. థర్డ్ స్లైడ్ చూపించండి సార్. నెక్స్ట్ స్లైడ్ థర్డ్.
ఓకే, అంటే ఇక్కడ నాకు మీ వాయిస్ కట్ అయిపోయింది అందుకని. కనిపిస్తుందండి
ఓకే.
ఇప్పుడు స్లైడ్? ఇదేనా స్లైడ్?
స్లైడ్ థర్డ్ స్లైడ్ చూపించండి సార్ ఒకసారి.
ఇదా? ఓకేనండి.
ఓకే సార్.
ఓకే, కంటిన్యూ చేయమంటారా నేను?
ఓకే సార్.
ఓకే. మెథడ్స్ క్యాలిక్యులేటింగ్ ద మెథడ్స్ ఆఫ్ డిప్రిషియేషన్. ఇవన్నీ తీసుకున్నారా? నోట్ చేసుకున్నారా ఇవన్నీ?
ఒకసారి
ఓకేనా?
మీరు చూపించండి సార్, మేము నోట్ చేసుకుంటాం.
నోట్ చేసుకుంటారా? పిక్ తీసుకుంటారా? టైం అయిపోతుంది కదా.
పిక్ తీసుకుంటాం సార్.
పిక్స్ తీసుకుంటున్నాం సార్.
ఓకే, ఓకేనా ఇది?
థర్డ్ స్లైడ్ నుంచి చూపించండి సార్.
ఇది ఓకేనా? నెక్స్ట్ ఓకేనా?
ఓకే సార్. ఫిఫ్త్ స్లైడ్ సార్.
ఫిఫ్త్ వన్.
ఓకే ఓకే, ఫిఫ్త్ వన్.
సార్ నెక్స్ట్.
ఓకేనండి.
ఓకే సార్, నెక్స్ట్ వన్.
సెవెంత్.
ఓకే, తీసుకున్నారండి సెవెంత్ కూడా?
ఎస్ సార్.
ఎయిత్ వన్.
సార్ నైన్త్ వన్ సార్.
ఓకేనా?
ఓకే సార్, 10th వన్.
టెన్త్ వన్ తీసుకున్నారండి?
ఎస్ సార్.
ఇది 11th వన్. ఓకేనా? 11th
12th.
అయిపోయిందా?
సార్ 12th సార్.
ఓకే, ఇక్కడే ఉన్నాం కదా, అర్లియర్ మనం వీఆర్ ఇన్ ద 12th slide.
సార్
right?
మెథడ్స్ ఆఫ్ క్యాలిక్యులేటింగ్ డిప్రిసియేషన్ లో ఉన్నాం సార్.
Okay. Sure. So there are different methods for calculating the depreciation, and the major methods that are used in the calculation of depreciation are straight line method and diminishing balance method. Both the methods are simple and easy to calculate the depreciation. The choice of selection of method for the calculation of depreciation is at the discretion of the management. Management can select any depreciation method, not only straight line method and diminishing balance method. Depending upon the nature of asset they are going to depreciate, they can select any method. But for the purpose of calculating the taxation, the method that is prescribed is the diminishing balance method. So depreciation is a under straight line method, depreciation is a constant charge. So whatever the amount we are charging in the first year, the same amount will be charged for the all years under the straight line method. And under the diminishing balance method, the depreciation cannot be similar in every year. Every year the depreciation will keep on changing. Under straight line method, what we will do is the 1% of depreciation is calculated on the book value on the first year of the first year of depreciation calculated. So that same amount will be taken forward every year equally through the entire life of the product. Under diminishing balance method, what we will do is, in the first year we will calculate depreciation on the book value of that asset. We will decrease that book value of that asset during that year, and the next year the asset value will come down. Again we will calculate the depreciation on that asset, and again we will reduce the asset value in the second year. After reducing the asset value in the second year, that reduced value will be taken to the third year, and in the third year again we will calculate other depreciation. Like that, in diminishing balance method, the value of depreciation will come down from higher level to the lower level, and under the straight line method, the depreciation value will be same through the all the years. So let us try to understand how the depreciation is calculated under straight line method of depreciation. As I already told, the calculation of depreciation is based on three components. One is the asset value, and other is the salvage or residual value, and the other one is the useful life of that asset. So asset cost is the actual cost of that asset that at the time when it was entered into the business, and the salvage value is the value of amount that can be derived from that asset after a period of its uses for a period of, say for example, 10 years. What will be the scrap value of that asset? So we have to reduce the scrap value of that asset from the actual cost of that asset, and it can be divided by the number of years that the asset can be used, so that we will get an average amount that we take as a depreciation every year. See here one example we can see. One company purchased a second-hand machinery for the cost of 96,000, and they spent an amount of 24,000 on its cartage. That is bringing that asset from outside to the company, and in the form of repairs and installation, it has incurred another 12,000. So when we club together, these two amounts is 96,000 and plus this 24,000, which was incurred for the purpose of these assets and making repairs to this second. Together, the value of asset will come back, and it was estimated that the scrap value of that asset will be 72,000. That means using this asset for 4 years, that value of asset will come down to 72,000 as per the estimate. Cost of that asset from the scrap value, and by dividing with the number of years, that is the useful life of that asset for 4 years, we will get the amount of depreciation as 12,000. This 12,000 has to be deducted equally every year for 4 years from this 1,20,000. 1,20,000 we have to deduct 12,000 for every year. So this is the process of calculating depreciation under straight line method. Rate of depreciation says that what is the percentage of depreciation we are calculating. So to calculate that percentage, the depreciation amount should be taken as a percentage from the cost of the asset. So that we will get rate of depreciation. Rate of depreciation is percentage of amount that we are deducting on the actual value of that asset. That is, here the amount is 12,000 and the cost of the asset is 1,03,000. Percentage of 12,000 on 1,20,000 is 10%. Therefore, the rate of depreciation to straight line method is 10%, and the depreciation is constant of the. This is the process of calculating depreciation under straight line method of depreciation. Can you see the slide now? The next slide, diminishing balance method. Can you see the slide?
Yes, sir.
Okay. Under the diminishing balance method, as I already told, every year we have to calculate the depreciation on the opening balance of the asset. So after reducing, will come down during that year, and we have to calculate the depreciation the next year on that reduced value. So value of asset will be the opening balance of that asset, and the depreciation rate can be fixed arbitrarily. We can decide the depreciation amount. Say for example, every year we can deduct 10%. So first year, if the value of that asset is 1 lakh, first year we will deduct 10% of that asset. After deducting the 10%, the asset value will become 90,000. And in the second year, we'll deduct 10% on that asset. So 10% on 90,000. That is, it will become 99,000. So the depreciation will starts reducing in the diminishing balance method. Whereas in the straight line method, same amount will be deducted in the all the years, and there won't be change in the value of depreciation. And also, for the purpose of calculating here, we can define it arbitrarily, or we can also calculate the rate of depreciation by using the following formula: 1 minus n root of residual value by cost of assets into 100. By using this formula, also we can calculate the depreciation rate that can be calculated based on the diminishing balance method. Let us see one example of diminishing balance method. So one manufacturing company purchased an asset for machinery for 10 lakhs. So the diminishing balance rate was defined as, here they defined it arbitrarily as 25%. So as I already said, in the first year, we can calculate 25% of this 1 lakh. The 25% of 10 lakhs is 2,50,000. So therefore, the book value at the end of the year will be 7,50,000. And in the second year, how we have to calculate the depreciation? In the second year, the depreciation will be calculated on the opening balance of the second year, that is 7,50,000. So on 7,50,000, 25% is 1,87,500. So after deducting 1,87,500 from 7,50,000, the book value will come down to 5,62,500 in the second year. Again, in the third year, what we will do is we will calculate depreciation on this 5,62,500. So accordingly, under diminishing balance method, the value of depreciation will be varying every year. So this is the major difference between the straight line method and diminishing balance method. So under straight line method, the will be similar all through the years. Under the diminishing balance method, it will be reducing every year based on the opening value of that asset or asset. So now let us see. Can you see the slide now? Accounting for depreciation. Yeah.
Yes, sir.
So as I already told, we will the matching principle in recording the depreciation. So every year we will reduce certain amount from the yearly profits. So when we deducted that amount from the yearly profit, so there will be simultaneously we have to reduce the asset value also. So that there will be a balance in the so that amount will be created as secret reserve in the form of cash. So we are not getting any. We will do is we will not reduce the asset value. We will keep the asset value as is value, and instead we will create a provision for that asset. Why we will do that is, so at the end of the life of the asset, we should have a amount that can be used to again purchase that asset. So for that purpose, we will create a provision for that asset. So provision as a liability balance. If you are not following any we're not interested to follow any that asset, then that amount will be form of reserves. That amount will be form of secret reserves in the cash. Okay, let us see. So for creating the provision
ఇగో
account,
ఇలా ఉంటది రాజ్యం.
for creating the provision account, we have to that account, we will create a provision for depreciation account or the profit and loss account. So that depreciation account will be settled and the provision account will be there in the balance sheet as a liability. And in the second case, what we will do is we will straight away reduce the depreciation value from the asset value and the depreciation value reduced from the profit and loss account. So there will be no any provision in the balance sheet. That amount, what is reduced from the profit, will be in the cash, in the cash reserves, secret reserves. So these are the activities for the depreciation and advantages and limitations of depreciation. The major advantage of depreciation is depreciation expenses can be can be so for the purpose of calculation of taxation, that whatever the amount we are reducing depreciation consider. So that is why the depreciation amount is mostly higher. That will be if it will be continued for longer period of time. But under the diminishing balance method, what happens is the depreciation amount will be reducing every year. So the purpose of calculating the taxation, the tax department has specified that diminishing balance method can be considered. So that what will happen? So, depending upon the relevancy, the company can straighten method or balance method so that they can reduce the taxable income. This depreciation also helps us to create provision for the treatment of assets. Sometimes, if you are not creating a provision method, we can create a provision, or we can also we cannot create a provision. If we can reduce that, the amount that we are reducing yearly, and there will be a final amount that is available for the replacement of the future. So, the process of the amount of depreciation will help us in the as a result of depreciation. Uh, whatever the capital expenditures we are making, so that capital expenditures, the benefits of that capital expenditures can be assessed properly, so that we can take a proper decision with respect to how we can consider it as a part of expenses, and so that accordingly we can show a better picture of the company. So the usage of capital assets can be better determined with the process of depreciation. And there are also certain limitations with respect to depreciation. See, one thing we have to understand is in accounting, nothing is perfect. In all the calculations are based on assumptions and all the assumptions, and so whatever the amount of depreciation that we are doing, so it may be and that we are doing accurate also. It may not be true all the time. So there will be inaccuracy in the valuation of an asset in the process of depreciation. And also, mainly the purpose of depreciation is also costly affair. So if there are more number of assets available with a company, so performing depreciation for all type of assets will be a complicated task. However, nowadays there are technology is there, so this may not be a big problem, but the creation of that infrastructure or IT infrastructure for the calculation and for the maintaining of record and for the generation of reports, it is going to be a costly as well as time-consuming process. For a big concern, it may not be a problem, but for a smaller businesses, it can be a it can be difficult for maintaining such an infrastructure. So with this, we can close the 4th unit and we can go for the 5th unit. Financial statement. See, we have so far studied about the process of accounting and the components of financial statements and what are the major adjustments that will be taking place in the financial statements. Then, what are these financial statements? What financial statements will give? So that again we can recall from the previous section that a financial statements are basically uh, four categories, and profit and loss account, balance sheet will give the financial performance and financial position of the company. The profit and loss account will give the summary of what are the various revenues that are received by the company and what are various expenses that are incurred by the company. So out of that, we will calculate the profit or loss, and we can also understand what are various types of gains and losses that are derived by the company by the sale of its long-term assets or by the settlement of its liability. So with this, we can try to understand what is the actual meaning of financial statements and meaning and nature of the financial statement. Financial statements are the actual outputs of financial accounting process. So whatever the financial accounting process that was done, that is recording, classifying, summarizing, all this will leads to the preparation of financial statements in the form of a profit and loss account, in the form of a balance sheet, in the form of a cash flow statement, and a shareholders equity statement. So this financial statement shows the economic position of the company by depicting the assets and liabilities position and profitability position. Economic position is in the sense, by looking at the financial statements, we can understand whether the resources are properly utilized by the company or whether it will be able to sustain its position in the long run. By looking at the financial statement, we can look at the actual status of the company by using the economic resource. So it enables the users. So by looking at the economic position of the company, the users of the financial statements can ascertain the future prospects of the business organization. In future prospects, in the sense, this can be derived by comparing with the other business organizations. So based upon its profitability and growth, we can look with other companies in the similar industries, and we can make a assessment about the actual future prospects of the company in terms of its profitability and in terms of its growth. Based on the information given in the financial statement, the performance of the management can also be evaluated. In a public organization, as already told, that business doesn't own anything on its own, or it will not run any on its own. It will be run by the human beings only. Human beings are nothing but the management that were appointed by the shareholders. On behalf of the shareholders, the management will take the decision in the business organization. So based upon the decision, the performance of the company will be decided. So keeping that in mind, we can also assess the performance of the management by looking at the profitability position or by looking at the asset liability position. We can see that there was a proper balance between the liabilities of a company and the assets of a company, whether the company is liquid or whether it is facing any problems. The management is taking whether the management is taking proper decisions in overcoming the challenges. All these things can be evaluated to a certain level, may not be to the maximum extent. Then the financial statements also provides information regarding the accounting policies and procedure followed in the preparation of the financial statements. See, profit and loss account, balance sheet, and cash flow statements and the equity statements are basically the summaries. We don't know how those values are recorded. What is the logic behind recording those transactions? So, to have an understanding about what is the logic behind those transactions, what are the policies and procedures followed in recording those transactions. So, in the financial statements or in the financial reporting process, the policies and procedures followed in the preparation of financial statements will also be disclosed. we can see there will be a lot of annexures and footnotes given in the annual reports of the company that will help to understand how the accounting process has been done, how various items has been recorded, and what principles the accounting items has been recorded. So the financial statement will be a comprehensive picture about the process of accounting that has been followed in the process of financial reporting. The financial reports, along with other forms of reporting like social responsibility reporting and sustainability reporting, correcting the financial statements are basically profit and loss account and balance sheet. These statements will also be supported by other reports also. Other reports like sustain social responsibility account reporting. That is how the company is doing service for the society. So that type of information can also be given in the financial statement as a supportive information to the for the purpose of analysis. And sustainability reporting has become a major uh, major issue because as we are contributing, it is related to the environment protection. Out of this, but based on the nature and meaning of the financial statement, we can also derive the objectives of the financial statement.
Uh, Sir, voice is not coming, sir.
Equity statement is prepared to show the that were met towards the equity shareholders. 1 year they will be paid dividends, 1 year they will not be paid dividends. So whatever benefits that the equity shareholders are receiving, how their equity position is varying in the shareholders statement. And this is the form of profit and loss account statement. So these are the profit and loss account statement. We can see that revenue component is given from operations and other in the cost of materials consumed, and item, as I told, that capital gains or losses, and the profit can be calculated before the extraordinary items also. Extraordinary items are may not be regular or something which is not at all related to the business activity. So by incorporating all those things, the profit company can be calculated and the tax expenses also be calculated accordingly. But this is for the shareholders. Again, some other statements can also be prepared for the internal purposes, for the purpose of making taxation adjustments. This is the form and content of a profit and loss account as per the company. Let us get the form of the balance sheet is comprises of two categories, that is assets and liabilities. In the liability side, we can see equities and other liabilities like non-current liabilities, that is they include deferred tax liabilities and other liabilities can be of different types, and you can do individual items. Current liabilities. Current liabilities are short-term in nature, trade payables and other current liabilities, and short-term provisions also. And assets. Non-current assets include fixed assets, tangible assets, capital work in progress, and unamortized expenses. Asset side also include inventories, trade receivables, cash and cash equivalent, short-term loans and advances, and other current assets. This is the form and different items that are in the available in the that are given in the balance sheet of a company. Again, the finally, to recall how the financial statements are useful and what is the importance of financial statements. So we can see that they will improve the financial transparency and visibility. They can help in making informed decision making, facilitates securing of funding from other sources, guides strategic planning process, ensures compliance and accountability, supports performance evaluation and benchmarking, enables effective stakeholders communication, aids in risk management and mitigation. Risk management means some problems may arise, and it will help to understand what are various types of risks a business will take. And this will also help to take a decision with respect to how to overcome those risks. It enhances the investors' confidence, will support internal control, governance for the internal control and governance for the management of the company. These are the uses and important financial under the meaning and nature benefits of financial reporting. All are interrelated to each other. And finally, the limitations of financial statements. See, all financial statements that are prepared are past transactions and events. So whatever happened only the financial statements. So that will not give a scope for the understanding the future prospects of it. We can only understand what was happened during a particular period. But depending upon the additional information given in the annual report, understand what will be the future prospects of the company, and it is difficult for a normal person. Financial statements involves accounting principles and judgments. So basically, they are subjective in nature and may not be accurate all the time. The focus is only on quantifiable data. So therefore, it may not capture the important non-financial factors influencing the enterprise performance. Like that, we have already discussed about social responsibility accounting and human resources accounting. So these things cannot be considered under the financial reporting act. So financial statements may not provide a complete picture of that we have already discussed, and what are the risks that the company may face in the future may also be not seen in the financial statement, but they can be provided as an additional comparison of that, and we can take a decision whether the performance of the company will be good or bad in the future. The financial statements of different organizations are hard to compare due to variation in the financial accounting methods and geographical differences. As we already discussed that method, so you may follow one depreciation method, the other company may follow one depreciation method, and depending upon the industry, each industry may follow practice accounting, whether it is India or US or UK. So the objectives and methods of preparing the accounting statements will be varying. So this is one difficulty that will help to that will hinder the comparison of financial statement among the companies. So these are overall limitations of the financial statements. So while interpreting the financial statements, we have to interpret the financial statement, or we have to understand the financial statements because of this limitation. That is, they are past in nature, they are subjective, they won't take the non-numerical demand, they will future risks and challenges, and and there will be diversity in the methods and policies followed by different industries in the company, different industries in the market. This is about the financial state. Okay. I'm closing the session. Okay. Have you taken all the PPTs?